The wealthiest people in the world do not manage money the way most people assume. They do not pick more stocks. They do not take more risks. And according to Long Angle's 2026 High-Net-Worth Asset Allocation Report, a benchmark study of 233 investors averaging $17 million in net worth, their portfolios look nothing like what financial media describes. The gap is not about access. It is about three specific habits. Habit 1. They reduce public market exposure as wealth grows. Among investors with over $25 million in net worth, public equities drop to 38% of the portfolio, not the 80 to 100% most retail investors carry. The difference moves into private equity, direct business ownership, and private market investments offering returns uncorrelated to daily stock movements and control that public markets cannot provide. Habit 2. They compress fees with precision. Ultra-high net worth advisor fees sit at 0.58% annually, per the Long Angle 2026 report, versus the 1% or more most retail investors pay. Every basis point saved compounds over decades. At scale, the difference is significant. Habit 3. They separate income from wealth building as early as possible. The Capgemini World Wealth Report 2024 found that 72.6% of ultra-wealthy individuals are self-made. The shared habit is not income level, it is that they deploy capital into assets generating returns independently of their time. Income covers expenses. Invested capital builds the wealth. The two systems are deliberately separate and never confused. Now, does this mean average earners should ignore public markets and chase private equity? No, and this is important. The private market advantages described above are structurally inaccessible below a certain net worth threshold. Minimum investments in private equity funds typically start at $100,000 to $250,000. Venture capital access requires accredited investor status, $1 million in net worth excluding primary residence, or $200,000 in annual income. Most of the wealthy person's allocation strategy is not replicable until a certain threshold is reached. But here is what is replicable right now at any income level. Fee minimization. Move from a 0.66% octave fund to a 0.015% index fund. The compounding difference over 20 years on any meaningful portfolio is substantial. And separating income from wealth building, deciding before the lifestyle absorbs the raise that a fixed percentage of every income increase goes into assets, not into spending, into assets. Those two habits cost nothing to implement and are available to every single person watching this video today. The specific net worth threshold where the allocation shift starts to make financial sense, when to begin moving beyond index funds into other asset classes, is not the same number for everyone. We build that threshold for 4 different income and net worth profiles. The number that applies to your situation is in .breakdown. Follow the wealth logic. We run the numbers nobody else bothers to run.